Good evening, Theo traders. This is Doc Severson for the nightly report for Tuesday, May 3rd. I'll start off by looking at the daily chart of the S&P. We dropped about 17 handles. We did not make a new low though, but we took back all of the gains from that low volume bullish day yesterday. So most of the activity occurred either overnight or into the first hour of the morning. The rest of the day was pretty much nothing going on. You can see the overnight drop here in the futures, and then as the cash market opened up, this is where we got the initial big drop here, and it looked like we were going to have a massive red day on all of the indices out there. However, we bounced, the bulls bought the dip again, and we ended up just going sideways for the rest of the day. Again, like I said, dropping about 17 handles. There was really no safe harbor, as even the small caps got nailed as well too. We had the NASDAQ has actually been in quite a swing to the downside already. This is actually leading the markets lower. And the Dow, which is normally a safe harbor, actually has almost exactly the same chart right now showing as the S&P. So while most other assets got whacked, it's not surprising to see that the bonds actually were rising quite a bit today. So nice bounce here on the bonds. We'll see whether or not these will rise from what might be this test of a higher low. So are we going to go for the next swing to the north, which is going to put more pressure on most other asset classes? Now I want to go back to the S&P for a minute to talk about the context of what we're seeing here. If we start with the left-hand chart, this is the monthly chart. The context of what we're seeing right now is a very, very large consolidation pattern. We've had massive volatility within this consolidation pattern, and it will continue until the price finally breaks out of this, either to the upside or drops to the downside from here. So again, what I feel is that there is 500 points of range at stake here, either to the upside or the downside. So we need to watch what happens very carefully from here, because we want to be on the correct side of that trend when it does occur. So right now the price is jammed up against this upper trend line around the upper range here, with very, very close to all-time highs on the S&P. The Dow's doing the same thing, although some of the other indices are trying to come hard off the bottom. The Russell 2000 is well below its recent highs, as are the transports. So if this uptrend is going to continue, one of the themes that I keep talking about here is that what we need to do is to see this print some form of higher low on the weekly chart. So this is really the case where you need to take a step back to take 2 steps forward if in fact this is going to break out to the upside. The alternate path for this is that as the low is printed down here, the price rallies up and fails at that point and creates a lower high, in which case we'll see a probably fairly rapid revisit of the 1800 bottom. Not quite what people are expecting right now, I know. So what's going to be so important over the short term is to not have any bias whatsoever and allow the price to trade within this range and really let the price action show us what this chart wants to be when it grows up, whether or not it's going to break out to the upside or whether it's going to fail one more time and head lower. Now I'd like to finish out today's video by talking shop on options just for a second. Again, we have the monthly, weekly, and the daily charts here, in this case on Apple. And the reason I'm putting all 3 time frames up is that we need to have the context for what's going on. Right now, Apple, after going berserk to the upside, is actually in quite a bit of selling pressure to the downside. But you'll notice as we look at the monthly chart here that the $92 level of this stock is holding up pretty well as support. And it's even got this important pivot right around 95 or so. So in between 92 to 95 is very critical support for Apple. And we can see even more detail on this if we pull out to the weekly chart, how important this is. And it's been tested now. 1, 2, 3, 4, and today makes 5 times down here. So this is kind of an ominous pattern right now, because what we're seeing on the weekly chart is a series of lower highs, equal lows. For those of you that are into chart patterns, this is just a great big version of a descending triangle. Usually this leads to a downside target, which equates to the open end of the triangle. Now you can believe that or you not believe that, whatever, but right now seeing the lower highs setting up right now is showing an enormous amount of pressure to the downside. So after banging on this for a while, one of two things is going to happen. Either these shorts are going to get baked and we're going to see this breakout to the upside, or finally pounding on the floor here is eventually going to give way and we're going to have a new form of resistance, which is now going to be upstairs at about 92. And if this does break, you can see kind of the potential for this is going to be somewhere down in this area. Can you imagine Apple down at $60 per share again? But that's not really what I want to talk about. What I want to talk about is understanding these levels like this and watching the price go bang, 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 and unable to get through that $92 level. And so what I did today, well, actually yesterday, was to sell what's called a bull put spread. So this is just a credit spread. Now, the way that most people would have you sell credit spreads is to pick something way out of the money like this and get yourself a really high probability, like a 90% probability of selling that option, or in this case, usually a spread, getting a credit at the entry of the trade, and then holding on until expiration with a really high probability that the price will stay above this level. Well, that works great 9 times out of 10, but the 10th time, all of a sudden the price comes dive bombing after your position, and you give back all of those profits from the previous 9 trades. I've seen it happen so many times. And this is why we always advocate limited risk trades. And so what we'd want to do in a case like this is set up a trade where you're seeking one and risking one. So setting up a bull put spread or a put credit vertical spread at this level with an expiration as short as possible, in this case this Friday, setting up like a 92, 93 bull put spread in this case, led to very quick profits. So basically we got a 42% return on risk in the course of one day, and all it took was just this little tiny bounce off of the bottom. And you know, there's also another benefit too, because you're playing right at the money. You're playing kind of close quarters combat, you're rolling up your sleeves and you're getting right in there at the price with your spread option. What you'll find is that the most premium is available right there at the money, as well as the fastest time decay when you set up a trade that's right at the money. So you can get in and get out within the space of a day, or perhaps less than that. Perhaps it's just the course of trading during a day. Whereas when you set up a trade like this that's out of the money, your time decay occurs much more slowly, and this is where you sit there and watch the clock every night, hoping and hoping that the price does not break through that level, waking up at 2 o'clock in the morning, checking the futures, making sure it hasn't happened yet. I've been there before. I've seen the light. These are the types of trades that we do now. Right at the money with unity, risk reward, it's the way to go. Hey guys, don't forget to catch Don Kaufman's session on Wednesday evening, the options happy hour, as he goes over dividends and how they can affect your option play. Thanks for listening. We'll see you then.